Hello, everybody. Welcome to Wiley Solution Walkthrough. This is Accounting Tools for Business Decision Making, 8th edition. This is exercise 20-16. Textbook authors are Paul Kimmel, Jerry Weingant, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley & Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or of Wiley. So before we say thank you to the bus driver, let's go ahead and take a look at our question. So right over here, we have Kalli Company makes 3 models of tasers. Information on the products is given over here. We've got Tingler, Shocker, and Stunner. Fixed expenses consist of $300,000 of common costs allocated to the 3 products based on relative sales, as well as direct expenses unique to each model of $30,000 Tingler, $80,000 Shocker, and $35,000 Stunner. The common costs will be incurred regardless of how many models are produced. The direct fixed expenses could be eliminated if that model is phased out. James Watt, an executive of the company, feels that Stunner line should be discontinued because of the company's net income. Now, we know that based on our prior looking at these kind of questions, we don't want to do anything until we actually go through and figure this out. So the first thing we're going to do is we're going to do something over here. We're going to say current, Tingler, Shocker, and Stunner. Graph over here, we're going to have sales, variable expenses, and we're asked to basically compute the current net income for Kalli Company. So we got total. Now, there's a very easy way to do this. You take 30,000 plus 70 minus 40, and you're going to get 60. But the reason why I'm going through and doing it this way is because this question is going to ask us to discontinue a segment. So what we're going to need to go through and figure out is that if we do, in fact, go through and discontinue a segment, what's going to end up happening. So that's kind of why I'm drawing it out like this. So my contribution margin, and my fixed expenses, direct, fixed expenses allocated, and then we're going to have our net total fixed expenses. And then we're going to have our net income. So over here, when I'm looking at this particular question, right? So my sales of Tingler are 300,000. Shocker, 500,000. Stunner, 200,000. For total sales of $1 million. Variable expenses, 150,000, 200,000. And then 145,000 for a total variable expenses of 495,000. And so over here, okay. So contribution margin, 150, 300, and then 55,000. And then our overall contribution margin is 505. Now over here, this is what it gets to be really important, is like where are the numbers coming from? So consists of $300,000 of common costs allocated to 3 department based on relative sales, as well as direct fixed expenses unique to each model. So the direct fixed expenses, 30,000 Tingler, 80,000 Shocker, and wow, my eyes are going and my students now understand that we got 35,000. Okay, so my total fixed expenses direct are going to be 145. Now, there's a couple different ways I could go from here. Is I could say, well, if my total fixed expenses are 120, that must mean that the allocated are 90, but we're going to do it a little bit differently. So my allocation for Tingler, Shocker, and Stunner, this is basically over here. This is based on 300,000 of common costs. And this is being allocated based on relative sales. So if I take my sales over here of Tingler, Shocker, and Stunner, okay, what I do is I say, okay, if it's being allocated based on sales, I want to basically say what is the percentage of the total sales. So this over here is going to be 30%, this is going to be 50%, and this is going to be 20%, or 300,000 divided by 1,000, 500,000 divided by a million, excuse me, by a million, 200,000 divided by a million. So over here, we've got percentage of total sales. My common expenses are 300,000, right? So this is what I need to go through and to allocate, right? Remember, our fixed expenses are made up of two parts. These are made up of both fixed expenses direct, and then we've got fixed expenses allocated. So over here, I'm going to take my percentage of total sales, multiply by the common expenses. I'm going to get my allocation. So this is going to be 300,000. Ooh, sorry. This is going to be 300,000 times 30%, 150, and then 60,000. And if I add up my allocation, I get 300,000. So now my allocated fixed expenses are 90,000, 150,000, and 60,000 for a total of 300,000. Now over here, my total fixed expenses are 120, 230, and 95. If I go over here, 120, that's where that number came from. 230, that's where that number came from. And over here, we've got 95,000 for total fixed expenses of 445. So the net income of Tingler on a variable costing income statement, it's going to be 30,000, 70, loss of 40, and then 60. So as I said at the very beginning, could we have just gone through and added up these three numbers and gotten to the total amount of the net income? The answer is yes. However, the reason why I went through this is that in order for us to go through and to analyze whether or not Stunner should be discontinued because it's operating at a net loss, we want to go through and do this part first. So now when we come over here, this is going to be significantly easier to do. So if I get rid of Stunner, what is going to happen? My sales are going to go away. My variable expenses are going to go away. My fixed expenses direct are also going to go through, and these are also my fixed expenses will be eliminated if it basically gets phased out. So this would also go away. Now I can tell you just by looking at this, and we're not done yet because we have to take the 60,000 and allocate it over here. But right away, if we eliminate Stunner, right, we're going to be losing more money. And why is that? It's because you're now having to take these allocated fixed expenses and allocating it to the Tingler and Shocker departments. Note over here too, when you eliminate a division, sales are going to be gone and variable expenses are going to be gone because those are technically varying with production. So over here, and it tells us that we can get rid of the direct fixed expenses would be eliminated if the model is phased out. However, the common costs, and this is 300,000, continue no matter what. So now what I would go through and do is I would say, okay, before this, I was going ahead and allocating basically for Tingler and Shocker. Now I'm down to just 800,000 in sales. So as a percentage of total sales, this is now 37.5%. This is 62.5%. So this is now going to be 300,000, 300,000. Multiply this through. So my new allocation, right? So Stunner, because the division is no longer going, this is going to be gone. But Tingler now has 112,500 being allocated to it, and Shocker now has 187,500 being allocated to it. Right? Remember, the common allocated costs don't change. So when I look at this business here, is that even though, right, even though my my fixed expenses are going away, just think about this. This has to be absorbed by somebody no matter what. So just be careful when you see a negative number, right? Don't immediately think that the division has to go through and be eliminated. Also remember too, companies like Amazon may intentionally lose money, Why? It's about market share. They're okay with losing money for a period of time in order to go through and to break into a business. So net income, if we discontinue the product line, and then should they eliminate it? The answer would probably be no. However, when would they want to go through and eliminate it, right? So over here, well, what if the fixed expenses direct, we're saying like 75,000. Let's just make this up. If this was in fact the case, right? So if this was in fact 75,000, right? So assume right? So if we assume that they're actually 75,000, and if we go through and eliminate stunner, what would happen? Well, right now we're at a net income of 20, but if we come over here and if we go through and get rid of the direct fixed expenses, and then we do our new allocation just to the new departments, all of a sudden, I'm now being more profitable. And if we think about it like this. When you see these types of questions, if the costs that if you're basically running at a net loss before any type of unavoidable expenses, that's what you're looking for in terms of actually if you're going to go through and basically make a segment elimination. So that was fun. All right. Let's see you on the next video. I want to thank Wiley for allowing me to do this. For how much longer, I don't know. I'm just kidding. I really do want to thank Wiley for allowing me to make these videos. And please don't forget to like and subscribe if you'd like to see any other kinds of solutions. Please feel free to ask for them in the comments. Have a great day.